Imagine a journey through a constantly shifting landscape, with periods of growth and prosperity followed by downturns and uncertainty. This is the essence of the business cycle, a recurring pattern of expansion and contraction that shapes the economic landscape. Just as a seasoned traveler relies on a map to navigate unfamiliar terrain, investors can rely on their understanding of the business cycle to make informed investment decisions. This guide serves as your roadmap to understanding this crucial concept, equipping you with the knowledge to navigate the complexities of the market and potentially enhance your investment returns. The business cycle is not merely an abstract economic concept. It has a tangible impact on the performance of different asset classes and sectors. During periods of economic expansion, businesses flourish, consumer confidence is high, and demand for goods and services drives corporate profits. This favorable environment often translates into strong returns for stocks, particularly in sectors like technology, consumer discretionary, and industrials, which are highly sensitive to economic growth. Conversely, during economic contractions, businesses face declining revenues, consumer spending contracts, and stock prices tend to fall. Understanding the relationship between the business cycle and asset performance is crucial for effective investment management. The business cycle is typically characterized by 4 distinct phases: expansion, peak, contraction, also known as recession, and trough. Each phase presents unique opportunities and challenges for investors, and understanding the characteristics of each stage is essential for developing a sound investment strategy. The expansion phase is marked by economic growth, increasing employment, rising consumer confidence, and expanding business activity. During this phase, businesses invest in new projects, hire more workers, and increase production to meet rising demand. Imagine trying to predict the weather without looking at a forecast. You might feel a chill in the air and see dark clouds gathering, hinting at a possible storm. These are like leading indicators in economics. They provide clues about future economic activity but don't guarantee what's to come. These indicators are essential tools for investors as they provide a glimpse into the potential direction of the economy. By monitoring these forward-looking metrics, investors can anticipate potential shifts in the business cycle and adjust their investment strategies accordingly. One widely followed leading indicator is the stock market itself. Stock prices are often seen as a barometer of investor sentiment and expectations about future corporate profits. When investors are optimistic about the economy, they tend to buy stocks, driving prices higher. Conversely, when they are pessimistic, they tend to sell, pushing prices down. Another important leading indicator is the Purchasing Managers' Index, PMI, a survey-based measure of sentiment among manufacturing executives. A rising PMI suggests that factory activity is expanding, while a falling PMI signals contraction. Section 2. Coincident indicators, taking the pulse of the economy. If leading indicators are like looking at a forecast, coincident indicators are like taking your temperature. They tell you what's happening right now. These indicators reflect the current state of the economy and provide confirmation that the economy is indeed in a particular phase of the business cycle. By monitoring these real-time metrics, investors can gain a clearer understanding of the current economic climate and adjust their investment strategies accordingly. One of the most closely watched coincident indicators is Gross Domestic Product, or GDP, which measures the total value of goods and services produced within a country's borders. Rising GDP indicates economic growth, while a declining GDP signals contraction. Another key coincident indicator is employment data, particularly the unemployment rate. A falling unemployment rate generally indicates a healthy economy, with businesses hiring more workers, while a rising unemployment rate suggests a weakening economy with businesses laying off workers. Know you've been a good friend, and that's in the thick and thin. Section 3. Lagging indicators. Confirmation from the rear-view mirror. Imagine driving a car and only looking in the rear-view mirror. You would see where you've been, but not where you're going. Lagging indicators are similar. They confirm what has already happened in the economy. While they don't predict future economic activity, they are still valuable tools for investors as they provide a broader perspective on the business cycle and help confirm the strength or weakness of a particular phase. One commonly used lagging indicator is the unemployment rate. Although we mentioned it earlier as a coincident indicator, it also acts as a lagging indicator because it typically peaks after a recession has begun and reaches its lowest point well into an economic expansion. This delay occurs because businesses are often hesitant to hire new workers until they are confident that the economic recovery is sustainable. Another important lagging indicator is the Consumer Price Index, or CPI, which measures the average change in prices paid by urban consumers for a basket of consumer goods and services. Section 1. Expansion, a time for growth and opportunity. The expansion phase of the business cycle is like springtime in the economy, a period of renewal, growth and optimism. During this phase, businesses flourish, consumer confidence is high, and the overall economic pie expands. It's a time when companies invest in new projects, hire more workers, and ramp up production to meet rising demand. For investors, the expansion phase presents a prime opportunity to capitalize on this economic upswing. One of the hallmarks of the expansion phase is a steady increase in gross domestic product, or GDP, a key measure of economic output. As businesses produce more goods and services, GDP rises, reflecting the overall health and growth of the economy. This expansion is often accompanied by a decline in the unemployment rate as companies hire more workers to keep pace with rising demand. With more people employed, consumer spending tends to increase, further fueling economic growth. This positive feedback loop creates a virtuous cycle of expansion. Section 2. Peak, the summit of economic activity. Imagine climbing a mountain, the air gets thinner, the views become breathtaking, but the path ahead starts to level off. The peak of the business cycle is similar. It's the highest point of economic activity, but it also marks the beginning of a potential descent. At the peak, the economy is operating at or near full capacity. Unemployment is low and businesses are generally optimistic. However, beneath the surface of this economic summit, warning signs of a potential slowdown may start to emerge. One of the key indicators of a peaking economy is a plateauing or slight decline in GDP growth. While the economy is still expanding, the pace of growth may start to moderate. The unemployment rate, which typically falls during expansion, may stabilize at a low level, indicating that the labor market is tight and businesses may struggle to find qualified workers. This shortage of skilled labor can put upward pressure on wages, potentially contributing to inflation. Section 3. Contraction, navigating the downward slope. Imagine a roller coaster beginning its descent. The initial drop can be exhilarating for some, but for those unprepared, it can be a jarring experience. The contraction phase of the business cycle is akin to this descent. It's a period of economic slowdown, characterized by declining GDP, rising unemployment, and a general sense of caution among businesses and consumers. While contractions can be unsettling, understanding the dynamics of this phase is crucial for investors to navigate the challenges and potential opportunities it presents. During a contraction, businesses often experience declining sales and revenues as consumer demand wanes. Faced with lower profits, companies may cut back on investment, reduce production, and even lay off workers. This rise in unemployment further dampens consumer spending, creating a negative feedback loop that can exacerbate the economic slowdown. The stock market typically reflects this economic pessimism, with stock prices generally declining as investors anticipate lower corporate earnings. Section 1. Sector rotation, aligning with the economic cycle. Imagine a gardener tending to their plants, knowing that different species thrive in different seasons. Similarly, savvy investors understand that different sectors perform better at different stages of the business cycle. This understanding is the foundation of sector rotation, a strategy that involves adjusting portfolio allocations based on the prevailing economic environment. By identifying sectors poised to outperform in a particular phase of the cycle, investors can potentially enhance returns and mitigate risk. At its core, Sector rotation recognizes that not all industries move in lockstep with the overall economy. Some sectors, known as cyclical sectors, are highly correlated with economic growth. These include industries like consumer discretionary retail, automobiles, travel technology, materials, chemicals, mining and industrials, manufacturing, construction. When the economy expands, these sectors tend to flourish as consumer spending increases, businesses invest in new equipment, and demand for raw materials rises. Conversely, during economic slowdown, cyclical sectors often experience a sharp decline in demand, leading to lower profits and stock prices. Section 2. Early expansion, seeds of growth and innovation. Imagine a field of wildflowers beginning to bloom after a long winter. Similarly, the early expansion phase of the business cycle is a time of renewed optimism, where the seeds of growth and innovation begin to sprout. The economy emerges from the depths of a contraction, and businesses, sensing a change in the wind, start to invest in new projects, hire more workers, and ramp up production. This renewed economic activity creates a fertile ground for certain sectors to flourish. One sector that typically outperforms during the early expansion phase is technology. With interest rates still low and businesses eager to invest in productivity-enhancing tools, technology companies often see a surge in demand for their products and services. Software, hardware, and semiconductor companies all stand to benefit from this increased investment in innovation. Moreover, as the economy recovers, consumers tend to loosen their purse strings, leading to increased spending on discretionary items like smartphones, computers, and other tech gadgets. Section 3. Late expansion, riding the wave of consumer confidence. Imagine a wave building momentum, carrying surfers towards the shore. Similarly, the late expansion phase of the business cycle is characterized by a surge in consumer confidence and spending, creating a wave of economic activity that benefits certain sectors. With the economy operating near full capacity, unemployment low, and wages rising, consumers feel more financially secure and are more likely to open their wallets, driving demand for a range of goods and services. One sector that often thrives during the late expansion phase is consumer discretionary. As consumers feel more confident about their financial future, they tend to spend more on discretionary items like cars, appliances, travel, entertainment, and luxury goods. Retail stores, restaurants, hotels, and entertainment venues all benefit from this increased consumer spending. Investors often see strong performance in companies catering to these discretionary needs during this phase. Section 1. The Federal Reserve, steering the economic ship. Imagine a ship navigating through vast oceans, facing calm waters one moment and turbulent storms the next. The Federal Reserve, often referred to as the Fed, plays a similar role in steering the US economy, using its monetary policy tools to promote stable prices, maximum employment, and moderate long-term interest rates. Just as a skilled captain adjusts the ship's course and speed to navigate changing weather conditions, the Fed adjusts its policies to influence the economy's direction and pace. The Fed's primary mandate is to maintain price stability, meaning keeping inflation under control. When prices rise too quickly, it erodes purchasing power, making it harder for households to afford goods and services. Conversely, a prolonged period of falling prices, known as deflation, can also be detrimental to the economy, as it can lead to a downward spiral of falling demand and economic contraction. The Fed aims to strike a balance, promoting a moderate level of inflation that is consistent with a healthy, growing economy. Section 2. Monetary policy tools. Adjusting the levers of the economy. Imagine a mechanic working on a car engine using different tools to adjust the various components and ensure it runs smoothly. The Federal Reserve, in its role as the mechanic of the US economy, has a toolkit of monetary policy instruments at its disposal to influence the money supply, credit conditions, and overall economic activity. These tools, used strategically, can either stimulate the economy during downturns or cool it down when it shows signs of overheating. One of the Fed's primary tools is the federal funds rate, which is the interest rate that banks charge each other for overnight loans. By adjusting this rate, The Fed influences short-term interest rates throughout the economy, affecting borrowing costs for businesses and consumers. Lowering the federal funds rate makes it cheaper to borrow money, encouraging businesses to invest, consumers to spend, and ultimately stimulating economic activity. Conversely, raising the federal funds rate makes borrowing more expensive, potentially slowing down inflation and preventing the economy from overheating. Section 3. Interest rates, the price of money and its impact. Imagine interest rates as the price tag on borrowing money. When the price is low, borrowing becomes more attractive, and when the price is high, borrowing becomes less appealing. The Federal Reserve, through its monetary policy decisions, plays a significant role in influencing interest rates, which in turn have a ripple effect throughout the economy, impacting borrowing costs for businesses and consumers, investment decisions, and overall economic activity. Lower interest rates, often implemented during economic slowdowns, make it cheaper for businesses to borrow money for expansion, hiring, and investment in new equipment. This increased business activity can lead to job creation, higher wages, and increased consumer spending, ultimately stimulating economic growth. For consumers, lower interest rates translate to lower borrowing costs for mortgages, car loans, and credit cards, making it more affordable to purchase homes, vehicles, and other big-ticket items. Section 1. Differentiating the tides, business versus financial cycles. Imagine the ocean with its rhythmic ebb and flow of tides. Now picture another set of waves, sometimes moving in sync with the tides, sometimes crashing against them. This interplay of forces resembles the relationship between the business cycle and the financial cycle. While interconnected, these two cycles have distinct drivers and rhythms that investors must understand to navigate the complexities of the market effectively. The business cycle, as we've explored, represents the cyclical upswing and downswing of economic activity driven by factors like employment, production, and consumer spending. It's the heartbeat of the real economy, reflecting the production and consumption of goods and services. The financial cycle, on the other hand, focuses on the flow of credit and money within the economy. It's influenced by factors like interest rates, investor sentiment, and the availability of credit. Think of it as the circulatory system of the financial world, channeling funds to where they're needed. Section 2. Navigating the interplay, investing through both cycles. Imagine, if you will, a seasoned surfer navigating a dynamic coastline, reading the waves, anticipating currents, and adjusting their approach to ride the swells successfully. Similarly, astute investors must learn to navigate the interplay between the business and financial cycles, recognizing the opportunities and risks presented by their convergence and divergence. During periods when both cycles are aligned. For instance, during a robust economic expansion with readily available credit and buoyant investor sentiment, growth-oriented investments, particularly in cyclical sectors, often outperform. Technology stocks, consumer discretionary companies, and industrial firms tend to benefit from this favorable environment as businesses invest in expansion, consumers open their wallets, and demand for goods and services surges. Riding the economic waves, strategies for each cycle phase. Picture a surfer paddling out to sea, carefully observing the rhythm of the waves, waiting for the perfect moment to catch a ride. Similarly, investors who understand the ebb and flow of the business cycle can strategically position themselves to capitalize on the opportunities presented by each phase. By aligning their investment strategies with the prevailing economic winds, they can potentially enhance returns and navigate market volatility more effectively. During the early stages of an economic expansion, when growth is nascent but gaining momentum, investors often favor growth-oriented assets. Technology stocks, particularly those involved in innovation and disruptive technologies, often outperform in this environment as businesses invest in new systems, software, and equipment to enhance productivity and gain a competitive edge. Consumer discretionary stocks, representing companies that benefit from increased consumer spending as confidence returns, can also present attractive opportunities. Tools and techniques enhancing your cycle analysis. Imagine a carpenter using a variety of tools, saws, hammers, chisels to shape wood into a beautiful piece of furniture. Similarly, investors can employ various tools and techniques to enhance their understanding of the business cycle and make more informed investment decisions. By combining economic data, market indicators, and analytical frameworks, investors can gain a more nuanced perspective on the economy's trajectory and position themselves accordingly. One widely used tool is economic data analysis. By tracking key economic indicators such as GDP growth, inflation, unemployment, consumer confidence, and manufacturing activity, investors can gauge the overall health of the economy and identify potential turning points in the business cycle. Government agencies, central banks, and private research firms regularly publish this data, providing investors with a wealth of information to inform their decisions. Mastering the cycle, a journey towards investment success. Imagine a ship reaching its destination after a long voyage, guided by the stars, navigating through storms and calm seas. Mastering the business cycle is akin to this journey. It's not about predicting every twist and turn, but about understanding the prevailing winds, adjusting the sails accordingly, and charting a course towards your financial goals. By grasping the fundamental principles of the business cycle, you've embarked on a path that can potentially lead to more informed investment decisions and greater financial success. Throughout this guide, we've explored the cyclical nature of economic activity, the key indicators that signal shifts in the cycle, and the impact these shifts have on different sectors and asset classes. We've delved into the role of the Federal Reserve, the power of monetary policy, and the crucial distinction between the business cycle and its close cousin, the financial cycle. Armed with this knowledge, you're better equipped to navigate the complexities of the market, identify potential opportunities, and manage risks more effectively. The business cycle endures, adapting to an ever-changing landscape. The business cycle, much like the changing seasons, is a constant presence in the economic landscape. It's a reminder that growth is never linear, that periods of prosperity are often followed by periods of retrenchment, and that understanding these cyclical fluctuations is essential for long-term investment success. As we conclude this exploration of the business cycle, it's important to emphasize the ongoing nature of this journey and the need for continuous adaptation. The world is in constant flux, shaped by technological advancements, geopolitical shifts, and evolving consumer preferences. These forces can influence the duration and intensity of business cycles, making it challenging to predict their precise timing and trajectory. The rise of globalization, the increasing interconnectedness of financial markets, and the rapid pace of technological innovation have all contributed to a more complex and dynamic economic environment.